bank transactions and bank reconciliation statements. So bank transaction and bank reconciliation statements involve transactions that an organization does with the bank. So it involves the comparison of cash book and bank statements. Now we know what a cash book is. We need to know what a bank statement is so as to compare both balances. So let's start with understanding what a bank statement is. A bank statement is a document sent by a bank to customer which shows transactions between the bank and the customer for a particular period. So it is said to be a periodic document, that is sent by the bank to the customer, which shows transaction between parties for a particular period of time. If you look at a bank statement, it shows features of dates, particulars, it shows debit, credit, and balances. Anything on the debit side will reduce the balance of the customer. Anything on the credit side will increase the balance of the customer. That is why when you receive alerts of money when you receive alerts of withdrawals, it shows debit alert, which shows that your balance will reduce. When you receive alerts of money being paid into your account, it shows that credit alert, which means your balance has increased. So credit will increase balance, debit will reduce balance. Now, what is bank reconciliation statement? Bank reconciliation statement is a statement prepared by an accountant to agree the difference between cash book balance and bank statements balance. So bank statement is prepared by the bank. Cash book is prepared by an accountant. So whenever there is discrepancy between the bank statement balance and the cash book balance, there will be a need to prepare a bank reconciliation statement. Bottom line, bank reconciliation statement will only be necessary when there is a discrepancy or when there is difference between cash book balance and bank statement balance. Let's look at the reason why we can have discrepancies between cash book balance and bank statement balance, which we all know as causes of difference between cash book and bank statements. Number one cause of difference is unpresented checks. Unpresented checks are checks issued for payment by a business organization for goods and services, but such check issued for payment for goods and services were not shown to the bank before preparing bank statements. If an organization issued a check to someone to make payment to that person, and the person fails to present the check to the bank before sending the bank statement to the business organization, it will cause discrepancy between the balance of the cash book and bank statement. Don't forget that the validity period of a check is 6 months, which means that a check is still valid for 6 months. And bank statement is a periodic document. All right, it could be every 2 weeks as the customer wants. It could be every 1 week. It could be monthly as the customer wants. All right, so let's look at the second discrepancy, which is uncredited check. Uncredited checks are checks received from customers from sales of goods. All right, check received from customers and paid into the bank, but not recorded in the bank statement. The check has been received by the business organization, recorded in their books, presented to the bank, but the bank has not recorded it in their bank statement. Probably the time of presenting the check, the bank statement has already been prepared by the bank. So it will cause discrepancy between the cash book balance and bank statement balance. Number 3 is dividend. Dividend is part of the profits of a company that is paid to a customer of a bank, and dividend is usually paid into the bank account of a customer, that customer must be a shareholder of that company. So whenever dividend is paid into the account of a business organization, the business organization's accountant will not know, because business organization is not an individual. An individual can receive alerts. Business organization does not receive alerts. Only the accountant will require the bank statement and go through it. So when an amount like dividend is paid into the account of the business organization, the accountant is not a wizard or a witch. He or she will not know until he or she goes through the bank statement. So dividend will cause discrepancy between cash book balance and bank statement. The next is credit transfer. Credit transfer is an amount paid into the account of a customer through a third party. If a customer, all right, a customer is seen to be a third party between the bank and the business organization. Now, the business organization is the customer to the bank. I'm talking about the customer of the business organizations now. So, if a customer of a business organization pays money into the account of the business organization, that person is seen to be a third party. So the business organization will not know except there is an evidence of payment seen. And even if an evidence of payment is seen, there's need to be there's need to substantiate if that payment is actually made or not. So credit transfer will cause discrepancy between cash book balance and bank statements. The next is standing order. Standing order is an instruction given by the customer to the bank, which enable the bank to make certain expenditure on their behalf. So if a customer of a bank give an instruction to the bank for the bank to make certain expenses on his or her behalf, so when the bank makes such expenditure, the customer will not know, except the customer goes through the account sent by the bank, which is the bank statement. The next cause of difference is what we call bank charges. Bank charges are deductions made by the bank for service rendered to the customer. Banks are operating to make profits. So for rendering services to customers, they charge customers. And those deductions are called bank charges. So as you are opening an account, you fill form that bank can make deductions for services rendered. So if they render services to you, they'll make deductions without you knowing. So when you receive the bank statement, you see the amount of deductions that have been made. And the amount of deductions is based on the services they've rendered to you within that period of time. The next cause of difference is dishonored check. Dishonored check are check received from customers and paid into the bank, but the bank refused to make payments. All right, bank refused to credit the account of the customer because there are some irregularities. So dishonored check will cause discrepancy because the customer has recorded it in his books, but the bank has not credited it because there are some irregularities. We could also have errors and omission. Nobody is above error. Bank could make errors, customers could make errors. Error could come from any of the parties. So these are the reasons why we have discrepancy between the cash book balance and bank statements. So the reason why we prepare bank reconciliation statements is because of these discrepancies. So if there are no differences between cash book balance and bank statement, there will be no need to prepare bank reconciliation statement. Now let's look at the format of bank. Let's look at the method of preparing bank reconciliation statement. We have two methods of preparing bank reconciliation statements. We have, you can prepare bank reconciliation statements only, which is method 1. And method 2, you can adjust your cash book. After adjusting your cash book, you can now prepare your bank reconciliation statements. When using method 2, you must observe these following. Number 1, you reserve these items for the bank reconciliation statement. Number 1, you reserve unpresented checks. Number 2, you reserve uncredited checks. And number 3, you reserve any error made by the bank for bank reconciliation statements. Otherwise, all other transactions will go through the adjusted cash book. Now let's look at the format of bank reconciliation statements. We have the format. As you can see, bank reconciliation statement as at so period. As you can see, we have balance as per cash book. So we had unpresented checks, we have uncredited checks, we have credit transfer. Then you less uncredited checks, you less bank charges, you less dishonored checks, you less standing order. Then you have your balance as per bank statement. So this will give you your balance bank reconciliation statement. You can also start from the back, just like this. If you don't want to start balance as per bank cash book, you can start with balance as per bank statement. So all the things deducted from cash book balance will be added here, like uncredited checks, credit transfer, bank charges, dishonor checks, standing out, you add it to balance as per bank statement. Then you less on presented checks, dividend, credit transfer. Then you have balance as per cash book. Let's look at this illustration. We have on 31st January, we have Baba's cash book showed a debit balance of 5,000. His bank statement showed the balance of 5,990. As you can see, that the 5,000 balance showed by the cash book is different from 5,990 showed by the bank statement, which means there's a discrepancy. So on comparison of the following, the following were found. So we want to look at the reason why we have this discrepancy. Number one, check issued amounting to 2,500 had not been presented for payment, which means this check is unpresented check. All right, which means we'll add it to balance as per cash book if you are starting the solution. Number two, we have the bank reject a check amounting to 150. This bank rejecting a check is called dishonor check. If you are starting with balance as per cash book, we are going to deduct dishonor check of 150. Number next, we have standing order of 120 to a club was not taken into consideration. So we have a standing order. We are going to deduct standing order 120 from the balance as per cash book. The next, we have the customer hire paid 180 directly into the bank without any notice to the firm. This is an example of credit transfer, which means 180 will be added to balance as per cash book. The next is bank charges of 170 were entered in the bank statements only. So bank charges made by the bank will be deducted from balance as per cash book. The next is dividend of 250 was paid directly into the bank and not recorded in the cash book. Dividend will be added to the cash book balance. The next, check for 1,500 were entered in the cash book but not paid to the bank, but had not been cleared, not credited. So this check is an example of uncredited check. So this check will be deducted from balance as per cash book. So what are we told to do? You are required to prepare bank reconciliation statement for the month of January 2013. Now let's take a look at the solution after analyzing it. So we have bank reconciliation statement as at 31st January 2003. The balance as per cash book is 5,000. All the things I said we had. Number one is unpresented check. Number two is dividend. Number three is credit transfer by hire. We had them together. We have 2,930. If we add it to 5,000, we have 7,930. So what are the things we're going to less? Like I said, uncredited checks, 15, standing order, 120, bank charges, 170. Then we have dishonor check, 150. If you add them together, we have 1,940. We are going to deduct this 1,940 from 7,930 naira. Then we have balance as per bank statement to be 5,990. So we could start with balance as per cash book 5,000 and we get balance as per bank statement 5,990. If we didn't get balance as per bank statement to be 5,990, as the question said, that means there is an error in our solution. So we can also start with balance as per bank statement. All right, and we are going to get balance as per cash book. Let's look at the next solution to see how to start with balance as per bank statement to get balance as per cash book. Now let's take a look. We have balance, we have a bank reconciliation statement as at 31st January 2013. The balance as per bank statement is 5,990. The things that were added to our cash book balance will be deducted here because we are starting with balance as per bank statement. And the things that were deducted from balance as per cash book will be added here. The things deducted from balance as per cash book were uncredited checks, standing order, bank charges, and dishonored checks. We are adding them here. Total 1,940. We add them to this. We have 7,930. All right. The things added to balance as per cash book, like unpresented checks, dividend, credit transfer to IO, we deduct them here. We have 2,930. We deduct it from 7,930. So we have 5,000. So my balance as per cash book is 5,000. So if you fail to get 5,000, it shows there's an error in your solution. So let's take a look at another example. The next illustration is that given below are cash book, which is bank column only, and bank statements of Kaka for the month of June 2013. We have the cash book. Balance brought forward is 5,000. Balance brought down. Balance carried down is 700, which means balance brought down is 700. You can see that the balance brought forward was normal balance. But the balance carried down is an overdraft, because an overdraft balance, we have a credit balance brought down, which means this Kaka has spent more than what he or she has. All right, Kaka has spent more than what he has, which means Kaka has used money from other sources to finance his or her expenditure, and thus such money cannot be probably taken loan, all right, and not stated in the books. So there's an overdraft balance of 700. Now let's take a look at the bank statement of Kaka. All right, as you can see, the bank statement of Kaka as at 31st June 2013. As you can see, we have dates, particulars, debit, credit, and balance. The things on the debit side reduce the balance. You can see the balance brought forward is 5,000. The balance brought down is 1,350 overdraft, but that of cash book was 700. Let me take it back. That of cash book was 1,950. That of cash book was 700. The balance of cash book was 700, which shows that this 700 is not equal to 1,350. So there is a discrepancy between bank statement balance and cash book balance. So there's a need to do what we call analysis, what we call bank reconciliation statement, to analyze the balance of cash book with that of balance of bank statement. We need to reconcile. Now, how are we going to treat this transaction? The first, we go to our cash book. We are going to check items on the debit side of our cash book. Those items on the debit side should appear on the credit side of our bank statement. Now let's take a look at them one after the other. We have Jackie B 12. All right, let's see. We have Jackie B 12 on the credit side, which means Jackie B passes the test. Let's move. We have Bat J 900. Let's check. We have Bat J 900. Bat J passes the test. The next is we have S Onuchi 12. Let's check. That means we don't have S Onuchi 12 on the credit side. All right, which means S Onuchi, all right, or maybe a dishonored. The S Onuchi has not been recorded. We see it as what? As unpresented checks. All right, now let's move on to the next. We have C Okoro 32. We don't have C Okoro on the credit side, so C Okoro can be seen to be on presented checks. All right, now we have the balance. So all we need to do, we go back to our bank statements. We only have two items here, and they are on the debit side of the cash book. If you have any item on the credit side of the bank statement, not on the debit side of the cash book, those items might be dividend or credit transfer, which means we've looked at the debit side of cash book and credit side of bank statements, and we've looked at credit side of bank statements and debit side of cash book. So the two items suspicious is that of S. Onuchu and C. Okoro, we are going to look at them from unpresented checks point of view. Now let's look at the credit side of our cash book and we'll compare it with the debit side of the bank statements. Now, the first is J Mama 3000. Let's compare it. We have J Mama 3000 on the debit side. Let's go back. We have Rita C 25. Let's check. We don't have Rita C 25 here. So that means Rita C is seen to be on presented checks. All right. Rita C is seen to be on presented checks. Now, please take note that S. Onuchu and C. Okoro are seen to be on credited checks. All right. While Rita C 25 is seen to be on presented checks. Note that. Now we have AA Ali 500. Let's check. AA Ali 500 is not there as well. AA Ali 500 is not there as well. Okay. So let's look at the next one. Martins D 2000. Let's check. We have Martins D 2000 passes the test. The next we have Abu H 22. We have Abu H 22. All right. The next we have Peter O 2000. Do you have any Peter O 2000? We don't have Peter O 2000. Okay. All right. So let's check. So that means for the credit card of cash, all right, we don't have Rita C 25. We don't have AA Ali, and we don't have Peter O, which means these three are seen to be unpresented checks. Now let's check the debit side of bank statements and compare with credit side of Cashbook and see what is not there. Now, as you can see, it's so obvious that bank charges is not there on the debit side of Cashbook. All right, it's even stated there as bank charges, and it's so clear that Jackie B as check is what dishonored. All right, Jackie B's check is seen to be what dishonored. All right, so instead of seeing Jackie B's check, so we have Jackie B's check being dishonored. All right, so this Jackie B, all right, his check is dishonored. So we are only after S. Onuchu and C. Okoro as our uncredited checks. Okay, all right, so let's proceed to the solution. All right, so we start with our adjusted cash book. The balance buffer will be on the credit side. We put our bank charges. I will put our dishonored checks. These are the items that will be in our bank reconciliation, in our adjusted cash book. Remember, when using this method of adjusted cash book before bank reconciliation statements, you reserve 3 transactions for your bank reconciliation statement. Just like I said, the 3 transactions will be unpresented checks, uncredited checks, and errors made by the bank. Now, we have recorded bank charges and dishonored checks. So our balance carried down is 1,950. All right, and our 1,950 balance happens to be a debit balance in our cash book. All right, so which means that our 1,950 happens to be a credit balance, which means our cash book balance is overdraft. All right, you can see 700 bank charges added to 1,2, everything we have 1,950. The balance carried out is on the debit, balance brought down is on the credit, which means we have an overdraft balance. Let's proceed to the bank reconciliation statement. As you can see, bank reconciliation statement for Kaka, the balance as per adjusted cash book overdrawn is 1,950. All right, normally, all right, our balances that should be, if you are starting with an overdraft balance, what should be added before Rita C, AA Ali, all right, and Peter O normally would have been deducted. All right, but because it is an overdraft balance, we are going to add them. All right, so this Rita C, AA Ali, and Peter O normally they will be deducted, but because it is an overdraft balance, we are adding them. So we have this. All right, then we less all these checks, then we have this. So we have an overdraft. We can also start from this balance, 1,350 balance as per bank statement overdraft. All these, if you had them, 4,400, you have 3,050. Then if you less all these, you have this 1,950 as our overdraft balance. If you do not have 1,950, it shows there is an error in the preparation of your adjusted or bank reconciliation statement. All right. So I believe you've been able to understand what bank reconciliation statement is, and you know what the discrepancy of cash flow balance and bank statements are. And by now, you know the method of preparing bank reconciliation statements. So till we meet again in our next class, bye for now.